I wonder your take on whether these negotiations, a 90-day pause for reciprocal tariffs that has been implemented to facilitate them, conversation around exemptions for certain products at the very least, are those things positive because it indicates the administration is trying to put a finer point, calibrate its tariff policy, or do they actually just sow confusion and potentially cause more harm than good?
Well, frankly, I think the entire policy has been misguided, the objectives unclear, the rationale for the tariffs that have been announced really unclear and not at all sensible. Steps toward removing the tariffs, lowering them, are positive, but we're in a world of tremendous uncertainty. I have no idea what will happen with these negotiations. The announcement about reciprocal tariffs indicated huge tariffs on some countries like Vietnam or the European Union based on bilateral deficits in trade, which is in no way a measure or indicative of unfair trade practices. It was suggested that these reciprocal tariffs are in response to unfair trade practices. That clearly wasn't the case. And for example, with the European Union, the trade barriers are very, very low. So I must say I'm confused about what the Trump administration will be looking for with Vietnam, for example. We actively encouraged Vietnam to begin to produce goods that we were dependent on China for national security purposes. We wanted diversification of supply chains. I don't think there was anything unanticipated or inappropriate about having a trade deficit with Vietnam. I find it very difficult to know what the Trump administration will be looking for or expecting.
Well, and of course, China's Xi Jinping himself was discussing trade with Vietnam today. On the subject of Xi and of the Chinese government, which, of course, you had many conversations with over your tenure as Treasury Secretary, you made tracks to Beijing yourself. Given your interactions with China and the way in which they have responded to the tariffs the administration has levied on Chinese imports, do you see them as willing to come to the table on this one, or are we stuck in a dangerous game of chicken?
Well, I think they've made clear that they would like to de-escalate this conflict and remove their own trade barriers, the retaliation they've announced, and see our trade barriers come down as well. I think they're tremendously damaging. They're at levels that are almost prohibitive of trade, and I think it would be beneficial for both sides. I will say in the case of China, and I've made this clear during my own visits there, we have legitimate grievances with some of the policies that China has followed to massively subsidize its export sector, its manufacturing sector, particularly advanced manufacturing, and its overall macroeconomic strategy, which places unusually low emphasis on consumer spending as a source of demand and really relies on flooding the world with Chinese goods. I think this is legitimately damaging to the U.S. economy and something that we were discussing, and I think there should be dialogue and an attempt by the Trump administration to pursue this issue. Working together with our allies, I think, would have been a desirable approach. It's one that we were committed to. But now the Trump administration has really engaged in some very antagonistic initiatives relative to our closest allies, and that looks like a less promising approach than I would have hoped.
Well, and you, Madam Secretary, together with the Biden administration more largely, were very deliberate in saying that the goal was not decoupling from China. Is that actually, though, what is going to be the effect of these policies, a decoupling?
Well, if tariffs at this level remain in place, it seems to me it must produce decoupling. And I regard that as very undesirable. I think the tariffs that we've placed on China are going to impose very significant burdens on American households. Now, of course, things are changing by the day. There's at least a temporary reprieve on auto parts that we learned about today. But reasonable, estimates of the impact on the average American household of these tariffs, the whole program, but especially China, is around $4,000 per household. This isn't good, and most of these goods we can't produce in the United States, or if we were able to do so, it would take years to shift production. And, unfortunately, with the uncertainty that surrounds these policies, I think most businesses are in a situation where they must feel paralyzed. You don't know if it makes any sense to cease production in China and to move it to the United States. And unfortunately, some of our closest allies no longer believe commitments that we make are good and will remain in force. So if I were a business thinking about coming to the United States to get behind the tariff walls, I wouldn't feel confident that when my factory came online several years down the road, that the tariffs would still be there.
I want to return to your point on the impact on American households and how this is already filtering into the soft data as we've seen consumer confidence deteriorating, consumer inflation expectations picking up. How quickly do you think that can actually translate into the hard data? And do you expect the hard data is going to start sending recessionary signals?
I think that's entirely possible, and it's something that I and others in the Fed will be watching very closely. I really haven't seen anything in the hard data that suggests a significant decline in either consumer or business spending. But there are very good reasons, as you mentioned, the soft data, the surveys. An overwhelming fraction of American households expect prices to rise at a time they're already tremendously upset about the high cost of living. And objective estimates, as I said, suggest that the tariffs will burden the average household by thousands of dollars a year, with particular harm to the lowest income households that their consumer baskets are tilted toward imports. So we could see a significant decline in consumer spending. Inflation expectations have gone up. They know that's going to happen. And business investment in this type of environment, I would really expect it to decline. We would be lucky to skirt a recession. And I would expect some indications in the hard data soon.
Well, and with your former Fed chair hat on, would you expect that that is what the Fed would react to, the side of the dual mandate that pays more attention to growth? Or if this is coming in tandem with inflationary pressures and rising costs, they can't theoretically respond to both at the same time.
Well, it is a very difficult conflict situation. The Fed has two goals, both of which are important: price stability and maximum employment. So, of course, if the Fed sees a weakening in the economy, the unemployment is rising, we've fallen into a recession, that will create a good reason, motivation to cut rates. But whether or not they'll feel comfortable doing so depends on what happens on the inflation side. Now, in principle, if tariffs rise and then stop rising, that should have an impact on a one-shot basis on the price level, and arguably should not permanently increase inflation after prices have moved up to reflect the tariffs. But you've seen inflation expectations move up in the data. We've been through a period in which there was a lot of inflation. Inflation's come down, but it's not quite down to the Fed's target, even before we see any impact of the tariffs. And you can't have second-round effects. So if households and workers start trying to bargain for higher wages to offset the hit from the tariff price level increases, this can create an ongoing inflation problem, and the Fed will be sensitive to that too. And that pushes policy in the other direction. Yeah. So I think watching very carefully what happens and acting on the basis of data both on inflation and the labor market will be what the Fed is doing.
Well, what about the Fed reacting or responding to the bond market? I wonder if we came close to the precipice of needing Fed intervention in the activity we were observing last week, Madam Secretary. And frankly, do you think that that kind of confidence signal that the Treasury market and currency markets were sending for to that extent with the weakness in the U.S. dollar is sending a justified signal about the viability of U.S. assets as safe havens?
Well, it did seem to me that the markets, both the currency markets and the bond market, were sending a signal that there's a loss of confidence in U.S. economic policy and even perhaps the safety of Treasury securities, which are the bedrock of and the safest asset on the planet. And this was a very disturbing combination of developments. Normally, when there's turmoil in the markets, you see longer-term Treasury yields going down because Treasuries are a safe haven and people sell risky assets and buy Treasuries. And we didn't see that, of course. Treasury yield shot up last week, about the most we have seen in many, many years, I think over a decade. And normally, if interest rates go up in the United States, you also see the currency strengthen. And we didn't see that. We saw the dollar weaken. And that is suggestive of a flight from dollar assets, reflecting a loss of confidence. Now, the Fed wouldn't respond directly to that unless what we were to see were signs of real financial instability, liquidity drying up in financial markets, in the Treasury market, a self-perpetuating deleveraging that could become very dangerous. And I don't believe we've seen that. The 10 and 30-year auctions last week of Treasuries were successful. Markets are, by and large, functioning normally. So I don't see that happening now. Things do remain volatile. If real financial stability concerns were to arise, I believe the Fed would think about using its liquidity facilities as it did at the beginning of the pandemic. But we're not at that point yet.
And finally, Madam Secretary, before we let you go, tomorrow is tax day. And knowing that there is a fight to raise the debt ceiling that is still in front of us, I know you can't see the receipts at the Treasury any longer, but you have had to oversee the extraordinary measures the Treasury has to conduct to keep things going in the interim before the debt ceiling is raised. How easily could the X date be pulled forward if receipts come in late? Do you expect that?
Well, that is always a very significant factor, and it certainly was a factor for us in 2023 when the debt ceiling was raised, that there was a weakness in receipts. And I am worried about that. I think the economy remains strong. There's been a lot of turmoil at the IRS, people who work in enforcement having been cut. it is a factor that could affect the timing of when the debt ceiling really hits.